Welcome everyone, and thank you so much for joining us in today's session. With me today are our panelists, who I'm going to ask to provide a quick introduction to in a moment. But before we do that, I think to set the scene, we have Julia Coe from the Dutch Good Growth Fund, who is going to set the scene by giving us a presentation and giving us some insights into the angel investment landscape in Africa and how it has changed over the past few years. Julia, over to you.
Okay, thank you very much, Alex. Can everyone see my screen? It's working right?
Yes, but perhaps you would like to just put it on. There we go. Perfect.
Yeah.
So now everyone has a great view.
All right, great. Good morning or good day or good night. I saw some people, connecting from very far. So thank you so much for being there. We are really aiming for as an interactive session as possible. So yes, I will just give a short introduction so we are all in the same pace, but we thought it would be great to hear firsthand from these pioneers, to dive into like some of the specific innovations. And then it's really about, opening up to you guys. So we want to hear from your experience. Please be so mindful to share more facts rather than opinions. And then when you do that, don't hesitate to also share that on social media. You've got hashtags DGGF, Sankalp, Africa 2022, and then the handle SCBD facility, and the other one is Sankalp Forum. With no further ado, we're gonna go about that. I just wanted to say a little bit of background. So my name is Julia Coe. I work for Triple Jump. We manage a few funds because we are a responsible investment manager. One of them is the Dutch Good Growth Funds, which invest basically into local finance providers that then invest or on lend to local SMEs. I won't give you the full presentation. Feel free to reach out to me. We have a booth. You have all my contact details. I'm more than happy to speak. But what is important is that we don't just invest. We want to understand whether these investments that we're supporting are actually making a difference. How do they really empower the local entrepreneurs? And that's why we have this knowledge program that I'm very happy to lead for now 6 years. And so back in 2019 at Sankalp as well, we launched a report that looked at early stage finance. And we looked at different models like accelerators, venture capital funds, but also angel networks. And at that time, it was really interesting because it was really, more traditional networks. Now, you fast track 3 years later, I think that the angel world has changed tremendously. We are going to get into that. Just before we get into that, I'd like to run a few polls. One is to understand a bit who you are. So we put some categories. If you don't find yours, then just put other, and we will kind of figure out who you are. Do you see? Yes, you see. So it's great. We've got quite a few entrepreneurs, VC investors, some angel investors, entrepreneur support organizations, very important for them, and some investors. Yes, we need them. Okay, thank you very much for that. I'll just run maybe just a second poll to just understand what you are a bit expecting from this session. We call it a knowledge sharing session for us. So let's see what you come from. But we also want it to be as interactive as possible. So we do want you to contribute your experience and learnings. I see a lot of learning appetite and also getting to know the right people. Okay, I'm going to stop it there. Share the results. Yeah, lots of learning appetite, learning the key people. Yes, getting inspired, contribute your own experience, even if you didn't think about it, it will come, I'm sure, in the discussion. All right, great. So thank you for that. Let me then move forward and give you a little bit more of the meat on that. So why in the end did we do this article? Well, basically what we saw a couple of things. One is that we saw a lot more activities with angel investing into like high growth ventures. And because these businesses are really drivers of innovation, but also productivity, but also job creation. We thought it was really important that we deep dive more into how do we make them actually access still the early stage finance that is so difficult to access. And then what we where we saw is, as I said in the study from 2019, we really spoke about angels really organized mostly into networks, or maybe they would invest into syndicates. But now, if you look especially at the names that you have here, really angel investors comes in all shapes and forms, and we have to acknowledge that. What is the most important is that they come in earlier and earlier, which is critical. But they had to find ways of being able to come in as early as possible. And that's why the models you will see and get to know better today, and also just please download the article because it's short, but it's full of critical insights. You will see that they are structured in different ways. They operate just differently. They run due diligence differently. And that's also what makes them successful in reaching out to more early stage, high growth businesses. So yeah, the numbers that you are seeing here are just extraordinary. If you think of more like traditional angel networks, if they make 4 to 6 deals per year, it's already quite a performing angel network because it's so hard. So that's why we thought let's dive into really what makes them kind of unique. So I said now they come in all shapes and forms. Yeah, exactly. You're not an angel investor 100%. It's you pick things of angel investing, of crowdfunding, and of venture capital. We saw venture capital is going earlier and earlier, but to a certain extent. So what are the keys that they pick to be there? I'll just highlight all of these things because now with our speakers, we'll dive into the specific topics. What we've seen also and why it makes them much more successful now is that the process lead times, including the due diligence, has been really reduced significantly. And we will see, maybe we'll have people like Zach and also Mariam who can tell us what makes that much faster. What we've seen so an increasing reliance on data and business model patterns. So because how these things kind of the secret recipe of what makes it work or not, if you see it there, then you can make decision much faster, and you can also focus on what type of value addition you're bringing. Because let's not forget, angel investing is great about all this early stage financing, but it's also fantastic because all the value addition that is being brought, the networks and the connections and the specific knowledge of the angels are bringing. The other thing that we see has changed quite a bit, and that can now be the case because you have much bigger numbers of investment, is that it's a new portfolio mindset. So now all these new models, will be able to focus more on upside than downside protection. And the last very important change we see in the landscape is also the widespread use of safe notes. And maybe for some of you, based in more like Anglophone Africa, safe note, you're like, oh, it's not the latest thing. But for Francophone West Africa, it's, the safe is actually only now kind of really available. And Hannah will tell us a bit more about that. So what we see is that for us, when we look at all these different models in all shapes and forms, these are the critical things that they have in common that makes them basically perform much more efficiently. I think that what we would want to do also with this session is to go beyond just the innovation and thinking in terms of financial return. We also want to understand two things. One is how scalable these models are, because we know that the early stage finance gap is the biggest on the continent. And so it's fantastic to see several initiatives work well, but how many of those, how do you bring them to really to scale to actually close the gap? And the other one is really important, is how inclusive are they? So we know even on our side at DGGF, we see the data, we do see the high number of jobs actually being created, especially from these high growth enterprises. But we'd like to understand better for whom are these jobs being created. Is it for young people? Is it for female? Is it really qualified jobs? We'll dive also a bit into these questions, and your perspectives on it will be much more welcome. And with this, I give the floor to Alex, who's going to smoothly moderate first the discussion with our pioneers and then hear from you guys. Thank you so much.
Thank you so much, Julia, and a big welcome to those of you who have just joined us. We are now going to enter into the panel discussion, and I'm about to introduce my panelists. As mentioned before, this is an interactive session, so please introduce yourself in the chat. But if you have any questions, please feel free to either raise your hand or pop them in the chat. We will have a broader discussion at the end of the questions and the key points that we would like to cover. Just a quick note that the link to the article that Julia was referring to has been posted in the chat. If anyone would like us to post that link again, and I'm just popping that in the chat as well, so anyone can have a look. It's a really great article. It's incredibly comprehensive, and so please do download it and have a read through the article. Perfect. I'm going to start off with Mariam. Mariam, would you like to please give us an introduction to yourself, the organization which you represent, as well as, I think for our audience, a quick overview of your investment strategy and your track record, just to give everyone in the audience a bit of a introduction to yourself.
Sure. Thank you. Thank you so much, Alex and Julia, for the invitation. I'm so glad to be sharing this panel with these amazing investors, Zach and Anna. Hello, everyone. So I've been, I'm wearing actually two hats now. I have been investing with Orange Ventures for 5 years, almost 6 now. And it's the VC arm of the telecom operator Orange. Our initial sweet spot is early stage, mostly A and B, but right before COVID, we spun out from the corporate and set up a seed stage fund. So we now have a separate governance, and we're building the foundations to welcome new LPs to be a standalone VC. So through the 2 separate vehicles, we invest across multiple stages from seed to Series B. And we are sector agnostic and up to date. We invested in 16 companies. And currently closing 3 across 8 countries, actually, in both Anglophone and Francophone Africa, in the likes of Yoko in South Africa, Trella in Egypt, Sherima in Morocco, Waspita in Cameroon. So the second hat I'm wearing is that I'm also the founder and an active angel investor at the Dakar Network Angels. It is the first regional angel network of its kind in Francophone Africa, investing actually in pre-seed tech and tech-enabled startups across 15 countries in the region. Amongst our recent deals in 2021, we closed Kori Money. It's a fintech addressing remittances. We invested in B2B e-commerce called Kweli in Senegal, and Commune, a retail tech company in Tunisia.
Thank you, Mariam. Over to you, Hannah.
Hi, good morning, everyone. Thank you very much, Alex. So my name is Hannah Sway Kamwanga. I'm very pleased to be here today. So I've been investing in Africa for the past, I think, 8 years through various capacities. Today, my main mandate, I would say, is country officer for Proparco, which is a French development finance institution through which we have developed and structured a startup strategy. With Proparco, we mainly invest through at the seed level. We have two main products. First, we have developed a tool called Bridge Africa, where we can provide bridge financing through debt for startups who are generating at least $300,000, $400,000 per year. Run rate monthly. So currently we are assessing 3 startups in DRC and or in Central Africa. So hopefully we'll be able to provide them with bridge financing. On top of that, we do the typical seed financing with co-investors. So typically investing up to $1 million in those startups. We also have a fintech based here in Central Africa that we are assessing currently. So outside my capacity as country officer for Proparco, I've been an angel investor for a few years, collaborating with few investment clubs. So Alex knows Dozen Angels. We met in South Africa. I've also co-founded a new club here in DRC this year. We've done our first investment actually in an SME 2 weeks ago. It's an SME called Savoki in the eastern part of the country, which is specialized in the manufacturing and distribution of local industrial cleaning products. But hopefully we'll do our first startup investment also in the next 2 months. And I'm collaborating with few funds, including Launch Africa Ventures, but Zach will talk about it. So very exciting to try to address the funding gap that we see, especially in Francophone Africa, that we see in female entrepreneurs, and happy to share my experience from the pre-seed to the seed level through various vehicles.
Thank you, Hannah. And last but not least, Zach.
Thank you, Alex. And may I just start off saying that it's an absolute privilege to be on a panel for change with women around us. It's usually the opposite, and I think and I hope this sets the tone for the future. We should have definitely majority women on panels, especially when it comes to VC and investing in startups in the continent, a thing that is heavily underrepresented. Thank you, everyone, for joining. Just very brief background. I've been an active angel investor in tech in Africa since 2013. So it's been almost 10 years, but 9 years now. I co-founded Startup Bootcamp, which is a global accelerator similar to Y Combinator, but focused mostly on B2B ventures across the world. And I co-founded the Africa operations together with Philip Kirchhoff in 2016. And then more recently, co-founded Launch Africa Ventures, which is now the most prominent and active early stage VC fund on the continent. We are truly Pan-African. So we backed ventures in 17 different African countries. We've made 94 investments as of last week over the last 18 months. And I'm always looking for smart, skilled, savvy angel investors to co-invest with us in the deals we do. And we look forward to making this second nature for a lot of people. So thank you.
Thank you so much, Zach. And my name is Alexandra Fraser. I'll be your moderator today. I'm also an African angel investor, investing through Dazzle Angels and in my own personal capacity. I'm a founding member of ABAN, the African Business Angel Network, and also one of the co-facilitators and initiators of the African Angel Academy. Great. So Zach, as you are our male representative on the panel, and I agree, it is quite refreshing to have and also great to be able to be joined by Mariam and Hannah and Julia, who have been in the ecosystem for so long. But we are going to start off with a question for you, Zach. So Launch Africa Ventures, the most active early stage investor in Africa. That's quite a title, and 94 deals done over a period of 18 months. That is, I'm surprised you managed to take a day off. That's, you know, on some weeks you must be doing multiple deals, and is quite something. To do that many deals at that scale and in that speed of time, how do you do it? We'd love to understand, like, what are some of the mechanisms? How have you structured Launch Africa Ventures to enable you to do deals so quickly? We saw in the paper that the ability to do deals quickly is becoming more and more important, especially when you're investing in kind of the next hot startup that everyone is trying to get into. So we'd love to understand some of the mechanisms behind how you've set up Launch Africa.
Sure, thank you, Alex. We get that question a lot. It's surprisingly easier than you think. But yeah, the gist of it is, you've got to set up your fund in a very, very careful structure. So even though this is boring stuff, it's very important that your fund structure is set up right. So if you're set up as a traditional VC fund in Delaware, for example, where you only have accredited investors that can be LPs in your fund, then you have to have a DFI-led LPAC, a limited partner advisory committee. It's very, very hard to get deal approvals in anything under 2 months, 3 months. So our fund is structured as a professional collective investment scheme for all the lawyers in the house, where every LP is a shareholder in the company, not an LP, even though the economics are an LP GP structure. We have a very solid investment committee. One of our top investment committee members is on this call, Hannah. And so from a DD, so that's one thing. The structuring of the fund is very important. Secondly, when you invest in early stage tech companies, you have to have a very specific mandate as to who you back and why you back them. Because I spent most of my career in my 30s building accelerators in the continent, we've got an incredible network with the likes of almost 35 to 40 accelerators in Africa. We built the first accelerator in Africa, so therefore we have networks with, Flat 6 Labs in Cairo and NILAB in Kenya, CC Hub in Nigeria, Alpha Code in South Africa. So all the regional accelerators, and then the global ones that have a presence in Africa. Now, why are accelerators important? For lots of reasons, but from an investing perspective, a lot of the tech is super clean. So you probably have either AWS or Google or IBM as your tech partner if you go through one of these accelerators. So a lot of the tech DD is already done for us because you've come through these accelerators, world-class accelerators, right? Number two, a lot of the legal work is already to point. So a lot of these companies, if you were to get into Startup Bootcamp or Plug and Play or YC, you couldn't get in and graduate unless your IP was held in the US, in the UK, in BVI or in Singapore, and you have really clear OpCo-HoldCo structures that are squeaky clean. So from a tech and legal perspective, the DD that we do is almost minimal because we've structured our intake process very carefully and smartly. So, and number three, we've got, even though our team is only 10 people full-time, we've got, we call them advisor networks in every major geography on the continent that are on the ground representatives that help us with local DD. So for example, in Egypt, most of our deals, we work together with Cairo Angels. In Tunisia, it's with Flat 6 Labs. So these entities don't get paid by us, but if we invest in a deal, a lot of these folks will end up having advisory equity in the portfolio company. So to your point, speed of execution is very important because companies are raising rounds in 1 to 2 months. As little as 4 years ago, they were raising seed rounds in 1 to 2 years. Mm-hmm. So if you like a deal, but you can't make a decision within 6 weeks, you're going to be booted out. So you have to work smart, not work hard, which is why we can operate at the level of, I tell people we have the operational efficiency of $100 million fund, even though we only have $33, $34 million in AUM. So those are some high level sort of ways in which we make it work.
Thanks very much, Zach. I think that gives us some great insights. And I think that efficiency, whether you are a fund, whether you're an angel network, is something that everyone is striving for, as many angels have businesses on the side. It's not their full-time job. So trying to get a decision made quickly and getting consensus and deals done is absolutely critical. Mariam, perhaps you'd like to also reflect on that with your experience of DNA and how you've set up the fund and how it operates. That would be really fantastic. Do you see it as a more traditional angel network, or have you adopted some of these new ways of working and doing things, and how have you built the organization?
Yeah. Thank you, Alex. So maybe starting with giving some context before, because when we started the angel network, venture investment was much more concentrated. I think now it's getting better because since last year, the 4 VC hotspots contribution to the total volume invested across the continent has decreased. So last year it was 73% compared to 80% plus the other years, the previous years. And outside those big 4, it is only last year that investment were, for the first time, equally distributed between Anglophone and Francophone Africa. So back in the days when we set up the Dakar Network Angels, the rationale wasn't only to close the funding gap between seed and early stage, but also to provide support, mentoring to the best Francophone founders and build really a platform of resources to help them scale. And I'm very happy that I was amongst the first investors to always advocate for Francophone Africa and making connections between active investors in Anglophone with Francophone founders. And today, here we are. I think now all eyes are on Francophone Africa, thanks to, of course, amazing founders, but also to awesome investors like Zach, but also Lofty Inc., Keppel Ventures, etc. So setting up a regional angel network instead of a domestic one was probably the first decision we made, because we wanted to solve one key issues of angel networks in this region, in Francophone Africa. Our countries are too small of markets to build domestic businesses. I mean, domestic successful businesses that can reach a significant scale. So, and on the other hand, the Francophone region has so much in common: language, currency, economic zone, regulation, etc., etc. So making the founders realize that there is a huge opportunity and offering them the platform to tap into these resources really made more sense to us and seem more sustainable than just building a domestic network. And I think we achieved that by now. I mean, we're on track to achieving it because we scaled the DNA from 20 to almost 60 members spread across 4 continents now. And we're closing a deal every 6 weeks. And of course, it was very challenging. When we started in 2019, our model was very much similar to any accelerator on the continent. We had one cohort every quarter, and it was taking, of course, a lot more time to close deals. Then, thanks to the amazing support of DGGF, and to a wonderful team of mentors with a sound experience on angel investing, we managed to make really big changes. The first thing we did was to hire full-time members to manage the investment and the network. Then we decided to have a continuous sourcing rather than the cohort system. So we're organizing investment events more often. So now every 6 weeks. And we invite startups to pitch every time. We've also set up a core team of members that they are in charge actually of deal screening, and also making the decisions for the network. We also streamlined our due diligence process so that we're able to close deals in maximum 3 weeks instead of 4 or 5 months in 2 years ago. So these are really the major changes. And of course, we went over a lot of hurdles before we get to this stage. I think there's one that is not really unique to our network. Finding the right talent to run such a network. Like VC funds, actually, it was very difficult for us to find local talent to run the network. And I think the other difficulty was also making the choice, the right choice actually of the jurisdiction. And I'm echoing here what Zach was saying earlier about the structure. Structure is very important. We lost so much time trying to compare different jurisdictions, the structure, etc. And finally, we set up our investment vehicle in Rwanda with a view to have access to both a low tax regime, but also low ongoing cost, of course, compared to Mauritius and other jurisdictions. It's currently set up as a private limited company, a company with several classes of shares, each tracking one investment, which is really interesting because I guess it's probably not very common for angel networks across the continent. Yeah, and finally, as most angel networks, we only had 22, I mean, we still have 20 to 30% of our members that are effectively investing in deals. This means actually our investment capacity is very limited compared to the potential. So thanks to ABAN, who's doing a fantastic work, educating angels, but also facilitating capital going to more ventures with the initiative, with initiatives like Catalytic Africa. We now have alternatives to increase our investment capacity. And of course, we're exploring more co-investment opportunities as well with local networks, angel funds, and early stage VC funds like Launch Africa and others, focusing on pre-seed and seed stage. Yeah.
Thanks, Mariam. And I think just also, Zach and Mariam, it's been fascinating to also hear how you've structured your networks and your funds, because I think that's something that many people really do struggle with, is actually how do you get the structures right, and how do you get, because that really does enable investments. Mariam, you also touched on the fact that having part of around making investment is also having the tools and templates to enable you to do deals faster. And Hannah, this is an area I know that you have been championing and doing a lot of work with, especially with ABAN, in terms of creating an OHADA compliant SAFE agreement. So for those of you in our audience who have not heard of a SAFE agreement, Hannah, perhaps you could give us a quick overview of what a SAFE agreement is, what the benefits are to both an entrepreneur and also to a funder, and then also talk about some of the work you're doing in order to make OHADA compliant SAFE documents and legal templates to enable investment in Francophone Africa.
Thank you very much, Alex. I think, as highlighted by Mariam, there are still a few issues and burdens that are preventing angel investors in Francophone Africa to invest as much as in Anglophone Africa or in Arab-speaking Africa. And people like Mariam are really fighting those issues and actually overcoming them. So it's very inspiring. So from my side as an administrator of ABAN, very humbly, we've tried to last year to put together some templates of legal documentations, not only for SAFE, investments, but also for equity investment and debt investment. You have to understand that SAFE agreements are not yet very used in Francophone Africa. So the investment, I would say, habits are not the same. And a SAFE agreement is basically an agreement that whereby an investor will invest a certain amount of money, which will give you access in the future to some equity in the underlying business when there is a priced round. in the next few months. Typically, you will have a discount when it comes to the pricing of this fund, which will give you access to an incremental amount of equity. This incremental amount of equity will be a true reflection of the risk you took by investing earlier. So I think we've done some progress in Francophone Africa because legal documentation was really a burden for many people. And actually, when we did our first transaction with DIA, like the Earth Impact Angels here in this SME in the eastern part of the country, yes, we had the issue where the SME had to change its legal structure because initially when they were set up, the founder thought that he was by himself. It's a company who still reached like quite a high level of turnover by DRC standards, like sort of 7-digit million turnover. So it was quite important for us to convince the founder to convert his legal structure so that institutional investors can actually support him. So through Aban, we're trying to do that, and we are always open to new suggestions coming from investment clubs, but also angel investors in terms of what they need to be able to invest. And if people here have questions, I'm more than happy to answer some of their questions as well. I don't know if there are any other points you would like me to tackle, Alex.
No, Hannah, that's fantastic. And just a quick reminder for the entrepreneurs in the audience, please do look at the paper because it gives a really great summary of the difference between a convertible note, an equity round, and a SAFE agreement, and how these different structures work and what the pros and cons of the structures are. I would like us to move on to actually discussing why angels are important for the entrepreneurial ecosystem in Africa and speak a little bit more around the actual entrepreneurs and the impact the entrepreneurs create. Julia, perhaps as DGGF, you could give us a little bit of insight because into why tracking the actual underlying entrepreneurs is becoming so important. I know it's important for you, but I think it's becoming really important for so many players across the ecosystem. And I'm sure the DFIs in the audience will also agree with you. So
yes, sure. Yeah, so we first started the work, when DGF was first started investing in 2014, we were there to help close the missing, like the financing gap for the missing middle. And so we bucked in there all of the SMEs that were too big for microfinance, but didn't match basically what the traditional investors, like banks or maybe private equity VC investors were looking for in these markets. And the first thing we did was to segment basically the SME sector. So it's not so much about like an oversimplification, because I think that we actually get to specificities, but to kind of look at what are the clusters, if you want, of SMEs. So we came up with 4 different groups of companies. So, and I think for us, it was really important because if you speak about high growth ventures, like the ones we are focusing on today, you're going to have your mindset much more different than if you speak about what we call more like the livelihood sustaining enterprises that don't have the same, potential for growth, don't have even like the aspiration for that, because just the type of product and their missions are just completely different. So we have these 4 different categories that we also, shared with the rest of the world into a report that is called the missing middles, so with an S. And then we dove into, okay, so if you have these different types of companies, it means that they have different characteristics and different needs. So that's how you link them to the most appropriate kind of finance solutions. So for instance, we are big proponents of mezzanine finance, but for a very specific type of company, which we call the dynamic enterprises that have, yes, maybe a moderate growth, but still, in terms of jobs sustained and created, you can see that happen. And so what was really important for us was, then you speak about all of these businesses, but who are the entrepreneurs behind? We did the exercise actually with young entrepreneurs. We ran the exercise now with women entrepreneurs. I have to say, everyone speaks about women entrepreneurs, but one woman and another are not the same. A woman who has a high growth venture is very different than a woman entrepreneur who has a dynamic business. So we did the work actually with young entrepreneurs, and we found that most of the, at least in our portfolio and underlying portfolios, most of the entrepreneurs that actually lead these high growth businesses are actually young, which means under 35 years old, which we found was interesting. But we wanted to dig deeper because, again, you know, if you are under 35 years old, it only says so much about you. What we dove into was more to understand first, what is their gender, you know, what is also their background, you know, level of education, what are, you know, the connections that they have already, to understand how basically these different models, you know, of providing access to finance are the best suited for them. And so that, for us, is really important. You would have some investors that would say, we don't invest into young entrepreneurs because they're just so risky because they've never done it. But depending on, you know, it's one way of looking at them. You can look at them like differently. So I think it would be really interesting actually to hear from the people here, and also if there is anyone in the room who wants to share, you know, what do you see are trends, you know, like the entrepreneurs that you back, are they young, are they women? What are the main characteristics that you would say also make you serve them the best?
Thank you, Julia. Zach, as you've done so many deals, and over the last 18 months, I think you'll be able to give us a really nice snapshot in terms of you know, what are your entrepreneurs typically looking like? Can you draw out any trends? And also, have you seen, I know it's quite early to say what the impact or what the economic impact is on these businesses in the last 18 months, but perhaps you could just share some stats or some insights and maybe one or two kind of examples from your portfolio.
Yeah, I think someone here earlier mentioned, let's stick with facts rather than opinions. Opinions are great. Nothing against opinions, but facts are better. So I'll stick to giving facts from within our portfolio. So those are undebatable, for lack of a better word. So we've invested in 94 companies so far. Of those, 90% are local founders, and I think that's a very, very important statistic, because there's been so much talk in the media about how the funding historically in African VC has gone to expat founders or foreign founders. I want to just iterate that in the last couple of years, that trend has significantly changed, which is a great thing for the ecosystem. There have been some really horrible stats when it comes to the percentage of women-backed and women-led founders. I think that statistics, correct me if I'm wrong, Alex, was like less than 1% in African VC last year, from what I read.
It was pitifully low.
Yeah.
Depressing. So rather give us some more positive stats,
Yeah.
Zach, I know you've got some positivity there.
Yeah, so in our fund, out of our 94 companies, 25% of them are women co-founded. 24 or 25% the last time we did our portfolio management. That is like 1,000% or 500% higher than the average in Africa. And we make a specific effort to look for women-led or women co-founded ventures, and local founders, right? Nothing against expat founders. But local, as they say in South Africa, people don't know as local is lekker, which basically means local is good. And also number 3 is it's important to see more local investors co-investing alongside international investors. There's no doubting the fact that when it comes to Series B, Series C, and Series D investments, the larger VCs are not on the continent yet, right? But at least at the earlier stages, pre-seed, seed, and Series A, we're seeing a significantly higher proportion of deals backed by both local angels and local VCs. So that's a good insight. In terms of sectors, the thing that we're seeing a lot of is fintech, as this is quite obvious, but fintech, but importantly, fintech and its derivative industries. Now, why do I say that, and why is that important? It's important to always have some sort of a fintech component to your business, simply because it opens the universe of potential partners and funding quite significantly. So I'll give you an example. We recently backed a company called Amitruck in Kenya, right? They did a Series A round led by a Silicon Valley VC fund called Better Tomorrow Ventures, and we were the largest investor on the continent. Now, Amitruck is a platform that allows logistics and freight providers to fill orders, not just for last mile delivery, but even for long distance carriers, right? So they would be classified as a logistics and mobility startup in everyone's book. However, a key part of their business is providing financing to freight providers and freight distributors and for transporters, right? And the platform that they have is directly linked to a special wallet that the freight providers have. So all of a sudden, the universe of potential investors now expands into the fintech regime, even though they're not a fintech. And I think it's important for any non-pure fintech founders listening in here to understand that when you have a fintech component to your business, it increases the scope of investors that could look at your business, because the beauty of fintech is in its inherent ability to scale. The moment you can pay and get paid and lend and borrow in multiple currencies across multiple regions, irrespective of what your core business is. It could be healthcare, it could be education, it could be mobility, it could be agriculture. But if there's a fintech component to what you do, your universe of partners and investors grows. And that's an important thing for not just our founders, but also other investors to be aware of. If you would extend this to be extreme, I'd love to hear Hannah's and Mariam's views on this, and your views as well, and Julia's. I actually think every single venture on the African continent is in some way, shape, or form a fintech business, in some way, shape, or form, but to varying degrees. That's an important thing when we come to looking at what companies to back. I hope that was a sufficient enough answer.
Thanks, Zach. I think we might be here for a little bit of time if we're debating whether all African ventures are a fintech, but certainly
have a fintech component to it.
Have a fintech component, but I do, and I think certainly when I think about our Dazzle portfolio, almost every single business has a fintech component with you, and I think that there is a huge amount of activity around that. I just wanted to also touch on some comments that are coming up on the chat, specifically the comments from Andy Hatfield, who is involved with the African Leadership Academy. And he really wants to know in terms of average age of your founders, because they're looking at supporting really young entrepreneurs. So Zach, perhaps you could just give us the average age of your founders, or maybe age range.
Between 25 and 35.
25 and 35. So according to the South African government, still defined as youth. Andy, a little bit older than your target market, or in terms of your super young, 15 to 22, but so 25 to 35, I would say that is very similar to our range. Hannah, Mariam, I don't know if you've got any comments in terms of some of the demographics or some of the breakdown of the entrepreneurs that you are backing.
Yeah, I definitely, I'm sorry. Anna, you can go ahead.
Okay, but then very quickly, I think through the various funds that I am collaborating with, whether it's Launch Africa Ventures or even Propaco, it's always a personal mission for me to try to identify and support for a few months, and then introduce founders who are always overlooked, whether it's, as you said, the color of the skin, the nationality, the gender, but also the nationality, what's the nationality, right? Because we know that some countries in Africa, like DRC, Cameroon, Madagascar, and a few others, even Ethiopia, we looked at a couple of opportunities in Ethiopia with Africa Ventures were quite interesting. But unfortunately, sometimes because of the country risk or perceived or real, those founders who are very talented and sometimes who have metrics even better than founders in Nigeria, Kenya, those people don't get the right level of funding. So personally, I'm really focusing on that and trying to tackle this. And I'm very happy to be able to do that with some of the funds. I think it's a vast topic, it's a vast debate. A lot of things need to be done, and I think if everyone focuses on doing their own part, just like Mariam and just like Dak, and to some extent myself, we are making progress. We have to remain optimistic, but there is still a lot of work to be done.
Mariam?
Yes. So with the DNA, actually, and even with Orange, we look at anything tech related. So the scope is really broad. In Francophone Africa, it is, and actually, as it is the case in the rest of Africa, fintech is definitely the leading vertical by far. And I agree with Zach. Every business in Africa has a huge fintech component, and it's, I think, related to the fact that every business has to sell, has to make payments, has to transfer. And unfortunately, in most of the countries, the infrastructure, the fintech, the financial services infrastructure doesn't exist at all. So startups are really trying to solve a huge pain point to enable businesses to scale. So it's like we used to say, tech is an enabler. But in the startup world, I think fintech is an enabler. So with both actually the DNA and Orange Ventures, most of the time we only see male, unfortunately, dominated founding teams pitching. We're really trying to find ways to have, to reach actually the gender balance. However, we're glad to back amazing female founders. We have one that we really like. She's the founder of Quelly, and she's amazing because she exited a company in the US and she's a repat. She just relocated in Senegal. Per our stats in 2021, I think we had 30 or 33% of the deals in our pipeline that were female-led. Age varies a lot. But I would say average is 25 to 35-year-old. And we're seeing a lot of repats who graduated from top business or engineering schools in the US or Europe, actually founding now companies. They have, of course, the connections, enough work experience, and of course, the management skills to do so. So quite similar to Anna and Zach's comments.
Thanks, Mariam. I'd like to just switch a little bit more just to ask around impact, because impact is also something that's key. And many of the entrepreneurs joining us today are building businesses with some kind of impact aligned to the SDGs. So perhaps we can do just a quick whip round to say beyond the SDGs specifically relating to financial inclusion, what are some of the businesses that you've invested into? Are any of them aligned strongly with the SDGs? And if so, which ones are kind of popping up strongly? Hannah, if we can perhaps go to you.
Sorry, Alex, I lost you for a second. Would you mind?
Sure.
Quickly, sorry.
Of course. So I was just asking about SDGs. So beyond financial inclusion or any SDGs relating specifically to fintech, are any of the businesses that are coming to you for financing focusing on any of the SDGs? Because there is so much activity in the space.
Yes, definitely. I think by definition, in Africa, we're all impact investors. Just when it comes to, reduction of poverty, access to healthcare, energy, education, with all those ventures in health tech, ed tech, also trying to give people access to the right infrastructure, transport, logistics, and all this kind of things. So by definition, I think in Africa, especially in sub-Saharan Africa, we're all impact investors. And yes, whether it's Launch Africa Ventures or an institution like Proparco, we are always making sure that when we're adding value to the founders we are backing, those founders keep in mind that they still need to operate through this kind of ecosystem and develop their business in a sustainable manner, not only because I guess ethically it's the right thing to do, but that financially it will just have a positive benefit in the long term.
Thanks, Hannah. Mariam, Zach, I don't know if you've got any comments around that.
Yeah, maybe just to say that our first investment with the DNA was in a clean tech startup called Coliba in Ivory Coast. They're not just they're contributing actually in formalizing an entire industry, because clean tech in this space, more than 90% of the plastic waste economy operates in the informal sector, and we're trying to track the impact they're making over time, and in 2 years they created 60 jobs, and 60% of their employees are women. So quite impressive.
I'm good for my side.
Okay, perfect. I think what we would really like, and I know that some of our panelists are unfortunately need to leave us quite shortly because they've got other commitments on the hour, but perhaps we can open it up to the floor, and there are a number of questions that we have for you, but also that have come through in the chat, which I'd love to really unpack. So the first is a question for all the panelists. Can you talk about your exit strategy for your investments? And what do exits for angels look like?
Yeah, I'm happy to take that. So I would strongly, I'm a huge believer in recycling capital in the ecosystem. As a fund, funds are usually governed by mandates and fund lives and investment holding periods versus exit periods, etc. As an angel, I would strongly recommend that when you have the first opportunity to create liquidity for yourself, that you do so. Typically, as an angel, if you're investing at pre-seed and seed rounds, you'll have an opportunity to get off the cap table at Series A. At Series A, there's typically 1 or 2 lead VCs that set the terms. And if you're an angel that's invested $10,000 to $50,000 in a startup, with all due respect to angels, the founders don't really want you on the cap table for too long. You've added your value in the first couple of years. Definitely at Series B, you're not adding a lot of value because you've got global VCs that are leading the team. So if you can, as an angel, always have a target return in mind, and I mean, this recently happened with me with Flutterwave. I was an early investor in Flutterwave from 2016, one of the first investors in Flutterwave, and I sold, my stake at their Series C round. There's this concept called seller's remorse that you probably heard of, like, oh gosh, did I sell too early? And the reality is you have to have the maturity to say, this is what I want to make on this investment. And as long as you use the proceeds of your investment to invest in other startups and accelerate the next generation of entrepreneurs, and that's okay. So how it actually works: when a company raises a future round of funding, the founders will allocate, in the majority of cases, a particular portion of the oversubscribed round towards secondaries, where you will sell your stake to the incoming syndicate of investors or investor, depending on what the deal is. And that will usually be either at the market price or at a slight discount to the market price. And that's something that I would recommend most angels consider doing. Unless, of course, you're a super angel and have millions and millions of dollars in your war chest that you can invest without having to get a return in 5 to 7 years.
Thanks, Zach. We have another question from one of the audience members, which is, what about angels investing almost at the R&D stage, or at the, I'm assuming this is almost at the idea stage. So an idea stage where providing entrepreneurs with the funds to build an MVP or almost achieve proof of concept. My first point is that for most industries, it's almost, it's become cheaper than ever before to kind of build an MVP, but it's certainly for some industries, founders do need initial capital to develop and test their idea or their prototype or their MVP. Mariam, Hannah, what are your views on funding entrepreneurs at an idea stage, or at such an early stage? Is it something you would consider?
I think Hannah may have had to have left. I'm just looking at her.
Yes.
Yeah, sorry.
Mariam, perhaps you would like to just comment on that?
Yeah, I was saying the same thing. Actually, I have to go because I have a investment committee waiting for me. But so the question was, do we invest at pre-seed?
Yeah, pre-seed. So would you consider an investment in an idea stage business, funding the development of the idea?
We did actually. We did with the DNA. I mean, with the Angel Network, we did. When I mentioned earlier the B2B e-commerce platform we invested in, it was at the idea stage, and we made this choice because really the founder is amazing, and it's all about supporting the right teams, right, at this stage. So, of course, we do.
Thank you, Mariam, and thank you so much for joining us. And we appreciate
Thanks
your
to all
time.
of you.
Great.
Most welcome. Very happy. Bye.
Great. Bye. We're going to open it up to the room, and I'd just like to ask the investors in the room, have you seen similar trends to what our panel has spoken about today? What has been your investment experience investing in early stage businesses across the continent? And if anyone would like to raise their hand specifically or make a comment, I know that we've got a number of investors in the room, and perhaps you could also just comment in terms of, does your experience echo those of our panelists today? Certainly, what are you seeing in terms of your investment portfolio and the deals that you are seeing? I don't know if anyone would like to comment directly. Andy, I don't know if you're still here, but you might have had to drop off. But if anyone else would like to comment, please do so. Feel free to either raise your hand or, yeah, Gloria, please do join us if you'd like to switch on your mic and your camera if you like.
Hi, everyone.
Hi.
Hi. Okay, so I'm Gloria Anderson from Tanzania. I am the founder and the executive director of Tanzania Enlightenment Development Innovation. It's a social enterprise that works in the improving the quality of education, improving the life of youth, as well as equipping young people with digital literacy. So we have a number of programs that we do, and also setups in terms of computer labs for schools. We also have a hub for young people, but we are also venturing into having an e-learning platform for young people. So I just had a question. I'm sorry I joined lately. Maybe you have already said about this. I was just wondering if all the investors who are here are also interested in the ideation of tech education tech ideas that focusing on empowering young people with skills that would allow them to be innovative and entrepreneurs across the continent. That was my question, my concern. Thank you.
Thanks, Gloria. I think there have been a number of investments in education platforms. I think you just need to, depending on the type of venture it is, but certainly there are more impact investors, I think, looking at the capacity development space, but there have been angels investing in the kind of skills development space. And Zach, I'm thinking about Andela specifically. Perhaps you'd like to comment or add anything to what Gloria was asking.
Yeah, I mean, was the question more around, is there funding available for EdTech ventures, or was it more around, what type of EdTech ventures do you think will attract the most amount of funding? Or
Yes.
is it the second one? Yeah. I mean, so Andela was the poster child for an EdTech on the continent getting international attention. I'm sure everyone's heard of them and how they got money from Zuckerberg and Chen, and then Al Gore, and now SoftBank. Or was it Sequoia? I forget. I think it was SoftBank. But yeah, so another very prominent EdTech called Go1 that's partially founded in South Africa and partially founded in Australia. It's received a lot of attention. So listen, EdTech's going to be a sector and subsector that will always have a lot of interest, especially since the pandemic, when the need for finding solutions to online education became more of a need to have versus a nice to have. Again, to my point I made earlier, EdTech in itself tends to be, again, I'm using my words very carefully, tends to be an industry that has very long lead cycles, from acquisition of customers to activation of customers to retaining customers to monetization of customers. When you look at investing in any early stage technology startup, the time to market and the time to monetization is often as important as the actual market size. So I've seen so many pitches and over the last few years where founders will pitch to us and say, hey, the target addressable market is 2 billion people, $20 billion worth of market size. And all that is good. I mean, nothing wrong with that. But it's a market that will take a very, very long time to monetize and acquire and retain and refer. So as EdTech founders, you have to follow an old physics law, path of least resistance. How do you get to your most active customers, your most viral customers, in as quickly a manner as possible? And how do you make them brand ambassadors for what you do? In the fintech industry, in the mobility industry, that is happening a lot. In the edtech industry, the percentage of early adopters in edtech is so small. I mean, there was a company that I won't mention names, but that got into Y Combinator a couple of years ago. Edtech company, brilliant company, but just couldn't monetize, right? So you've got to, as a founder, really figure out, how do I monetize quickly? How do I have multiple streams of revenue? I give talks about this often, about how you have to create a stickiness in your revenue. So one revenue model alone is not enough. You've got to figure out, as an edtech, can I do subscriptions? Can I do fee-based revenues? Can I do some sort of a recurring revenue model where I'm offering a course, but I'm also offering additional modules? I'm offering a learner management software system, but there's also a component of consulting fees coming out of it. I mean, edtech is a complicated industry, and you can't just be selling one product, right? Because there's a huge risk of, disintermediation in the edtech industry. So whilst we can all, celebrate the successes of Andela and Go1, there's a reason why the tier 2 in edtech is pretty far away. Right, so you've got to factor that in this industry. In addition to just saying edtech needs more funding, of course, edtech needs more funding, but it has to be monetizable, and monetizable quickly. Another reason why you don't see a lot of investment flowing into biotech and pharma in Africa is because angels certainly can't wait 17 years till a patent expires to realize returns, right? So you got to shorten those time to market and monetization curves, and then you'll see more funding.
Thanks, Zach. I also just have another question for you from Benjamin. So Benjamin's asking, given the rate of deal closure at Launch Africa, do you see your hub network as being enough of a pipeline for you? And do you perhaps look for, and I know you did mention advisors, so perhaps this is what Benjamin's getting to, but do you almost employ the VC scout method to really help scout for new investments? And I'd also love to ask, what percentage of deals that come to you have been referred by your investee portfolio? Because I'm sure that's also starting to become a really valuable pipeline, and I'm sure.
I'm divulging a lot of our fund secrets here, but it's cool. Just open source, right? So yeah, I'd say most recently in the last 6 months or so, the best deals by far have come from our existing founders. So, for example, we were early investors in Kuda, which is on its way to becoming a unicorn. Kuda is a digital bank in Nigeria. Kuda now has partnerships with other fintechs all across the continent, in insurtech, in lending, in credit, in data analytics. So if anyone from Kuda were to say, hey, Zach, or hey, Launch Africa, we're working closely with this company, we love them, we think they'd be a great addition to your portfolio. A logistics company, an e-commerce. So our founders are referring their friends, and they're just like investors have like an investor's code. Founders have a code amongst themselves that they don't talk about, but founders respect other founders. And if you as a VC do what you say you do and mean what you say, you get a lot of respect from founders, and founders will refer the best deals to you. So without being arrogant, we've worked very hard in building this for a few years. Our best deals come from founder referrals. And secondly, our best deals come from our LPs. So we've got more than 200 LPs in our fund. A lot of them see deals and would rather have us lead a deal versus them invest directly as an angel. So yes, our core deal source is still accelerators and incubators, but it's increasingly becoming our founders and LPs that are referring deals to us. So we don't spend much time looking for deals anymore. It's a good position to be in.
That is, and I think also, one of the the key things that you want as an angel investor is when your portfolio companies start also working together, leveraging each other's strengths and almost becoming each other's suppliers and clients, because then you suddenly knit together this network of your portfolio companies. And I'm sure with 94, you are certainly seeing that happen, which I'm sure.
Yeah, it's just to add a point here. I'm very happy to just drop more sort of pieces of just some nuggets of wisdom, for lack of a better word. Like if you look at the best funds in the world globally, so if what comes to mind, what Andreessen Horowitz, Sequoia, Index, Bessemer. But if you just look at Sequoia, for example, 25 years ago, they built a portfolio of companies that work with each other so synergistically that they create value for their founders more than the founders can ever create themselves, right? And in that scenario, that's when VC becomes magic. Gosh, what is someone doing here? Yeah, whoever's doing that needs to be booted off the chat. But yes, that is a big part of portfolio management, right? So creating synergies within your portfolio companies is super important.
Okay, someone's drawing on the slide. Okay. Thanks. Okay, we don't need the slides now. Perfect. I don't know if anyone else in the audience has some insights into, their angel investors who've invested into them, and what made a really good investor from the perspective of yourselves, the entrepreneurs.
Yeah, no, I was really eager to hear from the people who have joined us in the room, that they share also their perspective. I saw that we did have some entrepreneurs. Are there any entrepreneurs who did receive or have interacted with angel investors, and how were they? Yes, indeed, the most helpful, or did they have really yeah, if the interaction was not that great, like what were the big hurdles? Otherwise, you know, if there's no, you know, appetite to interact too much and people were there to really learn, I think what we can do is just, first of all, I'd like to thank so much everyone who has contributed to this session. Mariam and Hannah already left, but Zach, thank you so much for being also so open about what you see, what you learn. I think, you know, I call you guys pioneers. There's a reason. You're really moving and shaking the industry. So thank you so much for that. We have shared the link to the article where there's a lot of insights. I mean, you know, I think it takes you 15 minutes to read back to back. It's a worthwhile 15 minutes. And then maybe I had just a couple of polls to finish this session. Let me see. Yeah, simply to ask you guys if this session has met your expectations. While you answer, I wanted to give a big thank you also to Alex for very smoothly, you know, running us through these, you know, topics. I think that we didn't scratch the surface. On the contrary, we got to being very specific about, you know, what makes basically early stage investments, well, much more of them, you know, how are we closing the gap? And I see that, you know, most of you are super happy with the session, so that's great. I'll just run another quick poll, because what we are trying to see is, it's great to have an article, you know, because you can get into the details and have reference that you can use later. Just that, yeah, that is great to also, you know, get the real color and the details from the pioneers. So just looking into whether, you know, this type of mix, basically, of having, you know, an article, which is like a more traditional format, with a session like that was helpful. It's a very important question for us, is to understand whether, you know, with this session, you get a little bit inspired, and maybe with also more details from the paper, you actually are thinking of doing anything any differently in the way you work. Of course, it depends who you are. You know, if you're an angel investor yourself, maybe more than if you are well, even an entrepreneur, you can think, I think, quite differently. What is the fintech element in your company? And maybe that makes you look at your company a bit differently, and at investors also differently. Yeah. It seems that it's more a yes than a no, so that's great. And I run just the last question. Yeah, to just, you know, have you kind of open up, I guess. Yeah. Yeah, finding a way of blocking really unnecessary disruptions would be really good. We thought about, you know, that they can happen maybe more on a regular basis. But if you have any tips also on the structure and the dynamic, you can put them. You know, there is another category. All right. Okay. Yeah, I'm really sorry, because I love this session. It was so good, and really these things are really unnecessary. And yeah, so the Sankalp team did a great job at creating everything. Please, guys, also fix this one so we don't have that again. Again, a very big thank you for everyone who contributed to this session. You have the link for the article. You have a booth about DGGF and my contact details. Don't hesitate to get in touch with me directly. And yes, there will be a recording. Yes, it will be publicly available on the YouTube channel of Sankalp, so it can be further disseminated. And again, a million thanks to, well, Hannah and Mariam, although they are not with us anymore, but also especially to Zakaria and Alex. Thank you so much for all you're doing for this ecosystem. Keep up the great work, keep up also collaborating, because I think that was also pretty amazing. You see that people can change things because we collaborate. So thank you everyone very much.
Thank you, Julia, and a huge thank you to DGGF for investing in the African ecosystem. You do a huge amount of work, not only funding valuable insights in terms of research reports, but you have recently come on board as a funder for the African Angel Academy. So we're looking forward to training a lot more angels over the next 3 years, thanks to Julia and her team, but also supporting entrepreneurs, supporting angel investment groups like DNA. And for the entrepreneurs in the audience, also go and have a look at the DGGF website. There's some really great resources there as well. So Julia, just from us and the ecosystem's perspective, thank you so much as well for all the work you do.
All right, thanks everyone. Have a great day. Bye-bye.
Bye. Thanks, Zach.